The older I get, I realize that I have different taste in cars, in houses, in entertainment. I have different taste in food. And I realize that there's people out there that probably look at my approach and look at my way of doing things, and they're probably like, why would he ever do that? And I always think to myself, why would anyone not do that? And I've come to realize that there are so many different opinions and options out there because there's so many different people out there that have different opinions and ideas. Like, for example, when I go to the store and I see this just random thing on the shelf and I'm just like, who would even buy that? And then I realize there's probably somebody out there that would buy it because it's for sale, because it exists. And it just makes me realize that there's so many different opinions and ideas out there. Like, for example, you go and you look at different movies, different music, and you might listen to it and you're like, who would ever listen to that? And then you realize, well, there's a lot of people out there that actually like it. And that old saying, different strokes for different folks, really comes into play because there's something out there for everybody. Today, we're going to talk about an ETF that I've actually never covered in detail on the channel, and it's TSLY. This is one of these yield max ETFs. And this is one of those examples where I would look at this and, ask the question, who in their right mind would ever invest into this or be interested in this? And then I come to realize there's a ton of people out there that are really interested in it. And there's many different ways, many different paths that can lead to success. And so in today's video, I want to take a look at this article here from Michael Del Monte here on Seeking Alpha. The article is titled, TSLY Provides Investors a Significant Income Alternative. And if you're a long-term subscriber of mine, you probably already know what my thoughts and opinions are going to be on this, but I think you might actually be surprised at my honest opinions at the very end. Now, would I invest into this ETF? Absolutely not. Just like I would never go see the new Snow White movie from Disney. I would never do it. It looks ridiculous. I'll stick with the old version. There's different strokes for different folks. People have different tastes, and that's completely fine. And I am more of a person that is kind of a live and let live, right? If you want to do it, that's cool. But I want to take a look at this ETF and share my honest opinions and thoughts on it. And towards the end of the video, I'm going to kind of look at this from the lens of the core and satellite and how you could approach this. Maybe you are interested in this ETF, and that's what the beautiful thing about the core and satellite is it offers options and flexibility. And I think I'm not going to demonize anyone who would want to invest into this. This is absolutely not for me, but it may be something that you may be interested in. So yeah, it's a very short article, and then after the article, we'll take a look at a few comments. So the summary of the article here, Yield Max TSLY Option Income Strategy ETF TSLY, TSLY, generates income through the purchase and sale of options on Tesla without investing in the underlying equity. So they're not actually holding Tesla in the index. So there's going to be some hocus pocus with this ETF. It's not like you're investing into SHD and you own Coca-Cola. It's kind of some witchcraft going on. So the next thing here, the next bullet point, TSLY offers a high distribution rate of 74.47%. Wait, 74%? Wait a second. You're telling me that I can get a 74% distribution dividend? Really? Okay. Well, really? But investors face capped upside potential and full downside exposure to Tesla's share price. I recommend a hold rating with a 1 to 2% allocation in a tax-efficient portfolio to use distributions to generate cash flow. Okay, so let's take a look at it. So Yield Max TSLY Option Strategy, Income Strategy ETF TSLY is an actively managed investment strategy that seeks to generate income for investors through the sale of naked options on Tesla. If you know anything about options, naked options, that's always like the number one thing not to do. The portfolio strategy was launched on November 22nd, 2022, and current assets under management of over 700 million. So there's a lot of people that invest into this ETF. 700 million is quite a bit. And I actually think it was over $1 billion the last time I looked at it. I think it was like 1.1 billion last year when I looked at this ETF. As part of the investment strategy, the portfolio does not invest in the underlying equity and solely provides derivatives exposure to Tesla shares. So they don't actually own Tesla shares, which we'll get to in a second. Given the high income generation and the associated price decay as a result of the investment strategy, I rate TSLY with a hold with a 1 to 2% allocation in a tax-efficient portfolio. So how TSLY works. TSLY was launched to generate income for investors that are seeking exposure to Tesla through a managed options strategy. Well, you're not really getting exposure to Tesla if they don't actually own Tesla shares, which is kind of some witchcraft that I was talking about earlier. But yeah, so the portfolio will execute long, short, long, short positions. I'm actually reading this. I'm not making this up. So if you're just listening, I'm actually reading it. In the underlying stock while holding short-term U.S. Treasuries as an anchor to generate income. As of 9/19/2024, the portfolio holds 99.4% of short-term U.S. Treasuries and just 1% in cash. So this is the why they're not holding actual Tesla shares. It's through a derivative strategy, and they're actually holding short-term treasuries. In terms of the portfolio's option strategy, TSLY currently holds a straddle position consisting of negative 8.4% in Tesla. So these are the options that they're doing here. So here in 2025, 2024, and different prices for different timelines. The portfolio is also short Tesla September 2024 at the 230 call price or strike price, I guess, with a negative 1% weighting. The short options position, along with the short-term U.S. Treasuries, generate premium and income for the investors. So you can see here that they're actually holding treasuries and not actually Tesla shares. The income component is relatively robust with a distribution rate of 74%. The distribution pays out monthly as a result of the option strategy's performance. On average, the portfolio has paid out a rate of 94 cents per share. The average payout has modestly declined in the last year, having peaked at $2.13 a share in July of last year. Given the declining payout rate, investors should be aware that this trend may continue going forward. So you're getting a lower distribution, and I would be very curious how those are classified. They're probably mostly return of capital. They're just returning your initial capital to you, is my assumption. Another factor an investor must consider is that the portfolio's upside is capped if Tesla shares increase in value. That is with any cover call ETF, guys. If you have run a cover call strategy, one of the downsides is you don't participate in the raging bull market. If the share prices appreciate in a short period of time, you're not going to participate. You're sacrificing that growth potential for income. And so it's important that you understand that. A lot of people ask me, what are the risks of JEP-E, JEP-Q? That is one of the risks of these covered call ETFs is your upside can be capped, but that is why it's so important that you have a covered call ETF that sells out of the money where there's upside potential, where other ETFs like QLD sell at the money and there's really no upside potential. And so you're going to see the share price erode over time. And that has to do fundamentally with how the strategy is set up. Okay, and so the fund has full exposure to losses as it pertains to the underlying stock, resulting in a certain decay in share value. Given the cap of price growth, an investor must weigh whether investing in Tesla for income or Tesla for price appreciation suits their investment needs before making an investment decision. Yes, this is actually very, very well said. That's really what it boils down to. Do you want income or do you want the growth? Do you want the growth potential? And do you want to pay taxes now or do you want to pay taxes later when you sell your shares? And so there's different strategies of how you could do this. And that's why I always say on my channel, there's many different paths that can lead to success. And so it really just ultimately comes down to what are your goals, your risk tolerance, what you're trying to accomplish, and the risks that you're willing to take. TSLY displays considerable correlation to the underlying equity given a cap on price appreciation and full downside exposure. This may expose an investor to both correlated price risk and portfolio drawdowns. The portfolio's average daily trading volume sits at 815K shares, providing a modest amount of liquidity for those that may seek to enter or exit a position in TSLY. Yeah, you need liquidity because you want to day trade on TSLY. I mean, what? Like I said, people out there want to watch random Like, there's so many different people out there. Like, when I see this, I'm just like, who in their right mind would see that and think that that's a good thing? Yeah, bro, I'm going to day trade and swing trade on TSLY shares. Yeah. Oh my gosh. I got my cap backwards. Oh my gosh. Maybe 16-year-old me in my skater pants on my skateboard might think that this is cool, but man. All right, another factor worth considering is the associated fee for investing in this strategy. TSLY commands a 99 basis points expense ratio, a standardized fee across YieldMax's single name company strategies. That is, to quote the late Charlie Munger, that is an abomination. Absolute abomination that they would charge such a high fee. The only ones really making money here is YieldMax, right? They make this fee whether the fund does well or not. They're getting paid regardless of the performance. They're cashing their check at the bank every single month, and doesn't matter what the fund does. There's no accountability, okay? They're getting paid no matter what, and so the real winners here are the YieldMax fund managers, the ones driving their fancy cars and living in their expensive, condos in New York. Those are the ones winning. Okay. And so it's important that you understand that they're getting paid regardless of what the fund does. Okay. So really important that you understand that. So the conclusion is TSLY is a managed portfolio strategy that seeks to generate income for investors through a managed options strategy on TSLY shares. Though the ETF offers investors a significantly high distribution rate of 74%, the portfolio's investment mandate limits the upside potential and exposes investors to 100% of the downside risk as it pertains to TSLY's share price performance. Given the high income distribution, this ETF may be an appealing investment vehicle for those seeking to maximize income through exposure to TSLY. However, one must consider whether the income component outweighs the share price decay as a result of the investment strategy. Given the high level of income generated by this strategy, I recommend TSLY with a hold rating with a 1 to 2% allocation in a tax-efficient portfolio. I recommend investors using the strategy to raise cash as opposed to reinvestment. Well, that's the article. Let's take a look at some of the comments. The first comment here, YieldMax just added a new option strategy to all of their single stock ETFs to reduce NAV erosion and allow for unlimited capture of upside when the underlying stock goes up. Now, this comment just screams ignorant. Unlimited capture of upside. Do you know what unlimited capture and cover calls means, dude? Robert, I don't think you might want to go back to the drawing board with this one. I don't think that's the case. Now, I am not going to take the time to go look at more YieldMax stuff because, but I don't think that that's the case. Okay. Someone in the comments can please correct me if I'm wrong, and I will say, hey, I'm wrong, but I don't think that that's the case. Okay. So you have to understand cover call ETFs, when they're running this derivative strategy with options, they're trading the upside potential for income, for premiums, right? And so that's just how it works. So this unlimited capture is absolutely wrong. So the next comment here, I use income from TSLY and some other YieldMax ETFs to buy other dividend-paying ETFs. It's like using free money to build a passive income, and it's faster than other methods. Okay, you're going to get a lot of income, but have you looked at the NAV? Have you looked at your share price? So you're getting the income. There's kind of a trade, give and take there. But so, okay, if you really want the income. The next one here, the best strategy with all of them probably, I'm assuming he's talking about YieldMax ETFs, is to use their yield to invest in safer stocks with lower yields. All the YieldMax funds are helping me to grow positions in EPD, probably these, closed-ended funds or BDCs, I guess, and many others, which has a qualified dividend incidentally. Okay, so I've heard a lot of people on my channel talk about this where they're like, hey, I'm going to cheat the system and I'm going to get a high dividend and I'm going to use that dividend to buy other stuff, other investments. Yeah, I mean, you could absolutely do that. I mean, I'm doing it today. I'm using my dividends to pay for my water bill, to pay for my electricity bill, to pay for my mortgage, to pay for my gas, to pay for my food. You want to make sure that you're considering the tax consequences there. You want to make sure that the total return is not eroding the NAV. That's the share price plus the distribution together, right? That's going to be your total return. So you don't want to just look at the yield and be like, hey, this is free money. This is a guarantee. There's unlimited upside, unlimited, guaranteed. I mean, I got some magic beans to sell you if you're interested. I mean, come on, man. Yeah, okay. But yeah, coming back to what I was saying, yep, this strategy, I've heard many people talk about this, and it can work. You know, there's some pros and cons to it. I just would be and then a lot of people that say, hey, I'm going to throw in debt in there and I'm going to invest in a margin and I'm going to get the spread between the yield and what I'm generating. And it's a sure thing. Just be very careful when you come up with these ideas. If everything was 100%, why wouldn't everyone do it, right? Why isn't everyone doing it? And so I would just ask yourself that question. Why isn't everyone doing it? And try to poke holes at it. Yes, it may sound like a great idea, but try to play devil's advocate with yourself and try to poke holes at potential risks, downsides, and things that may happen that may not be on your radar. So that's some words of wisdom from someone who's made many mistakes in his life. So yeah, take it for what it is, I guess. The last comment here, the main issue with this instrument is that more than half of the income it tends to generate turns out to be return of capital in the form of a dividend or distribution. So it has the worst possible tax consequences. That's not exactly true. Return of capital can be a good or a bad thing. It just depends. It is not just income from selling covered calls. I saw a video featuring one of the big shots at YieldMax, and they recommended that you usually should buy more shares every month that the share price erodes to keep the overall value of your holdings the same as to generate a more stable income and sell as when it goes up. It has reverse split already, so it tends to go down more often than up. So yeah, you're going to see a lot of different opinions of how people can justify investing into investments like this, right? You buy a certain percent back to, maintain your cost basis or to maintain, growth in your income. Like there's a lot of things that people try to do to, kind of get around some of the downsides. But at the end of the day, you just kind of got to figure out what's the best approach for you and what are you comfortable with holding? Are you going to lose sleep at night with always thinking, oh shoot, is this going to be the month or the year that it gets cut in half? I mean, do you really want to live like that? But coming back to what I said at the beginning of the video, there's certain things in life what I would never consider, but it exists because some people like it. And not everybody has the same taste and the same goals and the same understanding of things. And yeah. So all in all, I would give this article a B. I think Michael does a good job when explaining the downsides and the risks of investing into TSLY. I think he does a good job at explaining who should consider it, having a very conservative amount, 1% to 2%. That's like a small satellite position. And even going so far as to saying that having it in a tax advantaged account. I think Michael is being very responsible with how he's recommending this. It's not like he's saying, YOLO, go all in like you would see maybe on Wall Street Bets or something like that. He's being responsible, and I do like that from him. The article is very short. It doesn't go into too much detail, but I mean, that's really the gist of what this strategy is and what these ETFs are. What I would have, I guess, liked to see is maybe some of the historical performance when comparing the total return against other covered call ETFs, or just kind of get a picture of what the performance has been relative to TSLY as a whole, or maybe the S&P 500. So yeah, but I guess all in all, in my opinion, to come back to reference what I was saying at the beginning of this video, there's certain people out there that have different tastes and have different opinions on what is good and what is bad. Like, I would never go to a burger joint and buy a 5-pound cheeseburger that has like grease dripping off the side of it. I probably would fall over from a, from a heart attack, but I'm sure there's other people out there that look at that and are like, oh yes, sign me up, right? So there's so many different things, different ways and approaches out there. And I am not going to judge anyone. If anyone wants to invest in this ETF, I think that is completely fine. Go to town, right? Who am I to judge? I used to invest in a penny stocks and I lost my butt and I had to learn, right? Maybe this is your learning experience. If you're gun-ho on investing in this ETF and maybe you're thinking, oh, Jake, the boomer, I'm a millennial, but you can call me a boomer. I have more of a boomer mindset. I guess the conservative mindset is the boomer mindset in terms of investing into these risk assets. But I guess, that's why I love the core and satellite approach to investing, because it's a guideline, right? It provides you flexibility where if you're a gambler at heart and you want to take risk, you can still invest into a core portfolio and you're going to turn out to be okay, right? Because you're protected, you're insulated, you're investing in a responsible way, but you can still have fun, right? A lot of people, they love to go to Vegas on the weekend and have fun, right? And the thing is they realize that that's what it is. They're there to have an experience and to have fun. The satellite positions, they're there. If you want to shoot for the moon, you want to invest in a TSLY or a Bitcoin or gold or, Michael Jordan baseball cards or basketball, man, I wish I had some Michael Jordan baseball cards. I think I actually saw some when I was a kid. I never bought them though. I wish I did. But if you want to invest into something that's maybe not like a traditional stock or dividend ETF or whatever, go for it. And that's why I love the core and satellite approach, because it allows for this type of behavior, right? Investing is very much a behavior, it is very much emotional, and it keeps you in check because you have your core portfolio. What I wouldn't do is heavily overweight into your speculative satellite positions. I wouldn't recommend it. I mean, you can do it. It's a guideline. Don't look at this as a rule. But I think, if you're really trying to reach financial independence and one day live off of your dividend portfolio, you're probably going to realize that you probably should stay away from this kind of stuff or greatly limit how much exposure you have to it. So, but yeah, that's my thoughts and opinions on TSLY. I've never really in depth talked about these ETFs. Whatever, like if people want to invest in them, be responsible, do your thing. I won't judge. I've made tons of mistakes in my past, but yeah, I hope that the video is helpful. I hope it gives you kind of like a way to look at these kind of things, right? And I don't want to be on any pedestal and say my approach is better, because it's not, right? Like my approach works for me. But I will say, if somebody eats a 5-pound burger with grease falling over the side, I will judge you. I will judge you. Just like you can judge me when I sit on my butt all day playing WoW. Like, you can judge me. That's cool. Everyone's unique in their own way, and I guess celebrating your own uniqueness is cool. But anyways, guys, thank you so much for watching. I appreciate it, and I'll see everybody in next week's video. Thanks for watching.